So with that, over to Charlie Erith to kick us off.
James, thank you very much. And thank you very much, everyone, for taking time out of your very busy post-Christmas schedules to join us today, wearing, I hope, your new jumpers and so forth. And welcome, of course, to ByteTree Asset Management and today's presentation, where we're going to discuss Bitcoin and gold, the outlook in 2021, titled Protect Yourself from Debasement. My name is Charlie Erith. I'm the CEO of ByteTree Asset Management. And I'm joined today by James Bennett, who's the CEO of our parent company, Crypto Composite. And of course, our chairman and chief investment officer, Charlie Morris. Just a very quick disclaimer to say that this entire presentation is for informational purposes only and in no way constitutes investment advice. So a quick preview of what we hope to achieve in the next 30 to 40 minutes. Firstly, I'm going to very briefly review 2020. It has, of course, been a monumental year, and I think in order to set the scene for 2021, we need to really understand what has just happened. And I will particularly talk about Bitcoin. James will then explore what's happening in the network. As many of you will know by now, we very much believe that Bitcoin is a network story first and foremost. And as much as there's a sort of macro narrative pushing investors towards Bitcoin, there is a technological growth story pulling people into the ecosystem, which is fascinating, but also probably harder to see from the outside if one's coming to this space early. And lastly, Charlie is going to talk in a bit more detail about gold with some great insights around flows, historic debasement protection, how the gold price has behaved relative to his model, and also look at valuations both of Bitcoin and gold and offer some thoughts about the outlook. And as James says, in the spirit of Christmas fun and games, we're doing a couple of polls as well, and we'll have the results later on. We'll open up to Q&A at the end. We've had a number of questions in from earlier in the day, but do feel free to stick questions in the chat box, or I believe you can figuratively sort of raise your hand via the raised hand button. Good. Well, as we know, it's been a totally unprecedented year. The overriding feature of it has, of course, been the extraordinary central government intervention in our lives, both politically and economically, as a result of this COVID pandemic. And the most obvious manifestation of this is of course, massive central government balance sheet expansion to compensate for the closure or partial closure of vast sections of the economy, which is shown here in this chart, which looks at the ECB in blue, Japan in purple, China in red, and the US in green. Moving to the next chart, you can see that the policy response triggered a rise in inflation expectations, as seen in the purple line, which is US two-year break-evens, which was followed, as you would probably expect, by a rally in gold, which reached an all-time high in August, which has slightly faded as other risk assets have taken up the baton. The green and red lines here are indices of the FANGs and high volatility stocks, respectively. Bitcoin, which is the black line there, dutifully follows the pack until the middle of October, when it quite clearly decouples from the other asset classes. Something else starts to happen here, which I'll talk about in a moment, but suffice to say, the forces at work provide a very compelling foundation for Bitcoin's outlook from here. And I just thought it'd be worth remembering at this point that the whole philosophy that underpins Bitcoin is that really of the Austrian school of economists, who to their credit have seen monetary debasement and malinvestment coming from a mile off, post removal of the gold standard, of course. Bitcoin was very largely created to address the growing manipulation of currencies for political ends, and to provide protection in times of inflation. And as the world has undergone this brutal shock from COVID, it is no coincidence that Bitcoin has started to attract a greater following. Importantly, though, it couldn't have attracted such a following if the structures around it were still brittle. This is a chart of Bitcoin's price this year, starting here's 2020, the beginning of January there. But those structures are no longer brittle. In fact, the infrastructure around Bitcoin has been enormously enhanced and improved over the last 2 years, which is actually one of the main reasons we felt able to move ByteTree into the next stage of its development and into asset management. So the groundwork has been laid for greater adoption, even if the market hadn't really realized it yet. That said, the start of the year for Bitcoin was pretty uneventful. It was dominated by the fanfare over the halving event. For those of you who don't know, this is when the new supply of coins into the market halves. It happens once every 4 years. In our view, given the state of Bitcoin's evolution, this is pretty much a non-event because we already know the supply, but it's certainly a chance for some enthusiasts to make a lot of noise. The rise we can see early on in the year can be partly attributable to that, in our view. But of course, the price was then completely crushed in the pandemic panic in March. It recovered along with other risk assets, but we can see that the halving had no great impact on price as we would have expected. Then things start to get interesting. Firstly, Paul Tudor Jones, who's one of the great investors of the last 30 years, announces a small position, calling Bitcoin the fastest horse. Much more importantly, we then get the OCC, the Office of Currency Control, effectively in the US, allowing domestic banks to custody crypto. And this is symbolically hugely important, amidst widespread worries about regulation. This is effectively the regulator saying, we are not going to ban this. We're going to accommodate it and find ways of engaging with crypto. And this, in fact, is a sentiment recently echoed by the acting controller of the currency, Brian Brooks. From this point onwards, the noise starts to get much louder with the announcement from Microstrategy that they've reviewed their capital allocation policy and are putting an initial $250 million of their treasury assets straight into Bitcoin, which again was super important, not just because it was so sort of left field and unexpected, but also because they were allowed to by all the regulators, accountants, lawyers, board of directors, and so forth. So once again, a tacit but vital regulatory stamp of approval. Then the UK regulator also gets involved. This has zero negative impact on the price. Indeed, it marks the start of the fourth quarter rally, which really goes to show, of course, that it's the US regulator that matters here. And at this point, the fun and games really start, and a growing number of participants start to appear. Not to mention things like Grayscale, which manages a crypto investment trust, and which Charlie will touch on later, which saw its AUM start to balloon. And then towards the end of the year, we see Massachusetts Mutual and Ruffer announce positions. And I've put these in a different color because they represent a different type of investor. The ones preceding them are, I'll probably get sued for this, but they're kind of largely maverick. They're dominated by individuals. Ruffer and Mass Mutual are, one suspects, more kind of committee-led and less trading-oriented. And they therefore, in a way, represent the kind of next level of serious institutional investment. And on this basis, I think we can say that as far as institutional money coming into the space is concerned, we really are still only seeing the tip of the iceberg. I just want to touch on MicroStrategy and Ruffer because in a nutshell, they encompass the sort of divergence of investors who are allocating to Bitcoin. In a sense, they couldn't really be further apart. Michael Saylor is a tech entrepreneur who has lately come to understand the impact of fiat debasement on the riches his company's built over the last 30 years. And he's converted all his treasury in assets into Bitcoin. I think really, critically, when we think about him, he's coming from a position where he properly understands the power of networks. He wrote a book called The Mobile Wave about this back in 2012 and was a very successful investor through understanding the strength of the Amazon, Facebook, Google networks and the fact that they got to a position 10 years ago where they crushed all their competition and were ready to make hay. And he very much draws an analogy with Bitcoin at this stage of its life, which is something we'd completely agree with. Ruffer, on the other hand, believe that proper wealth management is more about the preservation of wealth. They don't blindly follow the crowd. They tend to underperform, dare I say it, in momentum-led bull markets, but have a tremendous, extremely high quality record through crises. And although the company still carries the name of its founder, Jonathan Ruffer, it does act like a proper investment management institution and is certainly not managed at the whim of one individual. They come from a tradition of owning gold, unlike Michael Saylor, who is kind of new generation, tech-orientated, and really it makes interesting comments about gold, but sees Bitcoin as a far superior store of value. Ruffer are coming from the position where they are trimming their gold in order to buy Bitcoin. They describe Bitcoin as a small but potent insurance policy against the continuing devaluation of the world's major currencies. And the other thing I think is very interesting about Ruffer is that they have demonstrated that it is possible at an institutional level to own Bitcoin as part of a diversified long-term portfolio. And I wonder whether this is going to create pressure for others to follow in their wake. I know a number of wealth managers whose clients have been asking about Bitcoin and who to date have simply said that an investment is not possible. Well, Ruffer have demonstrated that it is, and it'll be interesting to see whether others will have to find ways to emulate them. So the second half of 2020 has been utterly remarkable for this new asset class in ways it was totally impossible to forecast 12 months ago. And this is because, if we think about it, everything has come together at exactly the right time. First, the pandemic, and it's the rescue measures that accompanied it and the subsequent fear of inflation have come along. That's precisely what Bitcoin is designed to do, is to protect your wealth against inflation. Secondly, we have an infrastructure around Bitcoin which has become of enterprise grade at exactly the time it's needed. And now finally, it is at last, very slowly, being endorsed by some of the smartest investors in the world, who are drawing the same conclusions, even though they come from very markedly different backgrounds. But there's even more, I'm pleased to say, and James will now give you an insight into what's happening elsewhere in the ecosystem.
Okay, thank you, Charlie, for that. So it's a bullish story across the board for Bitcoin. Bitcoin user adoption has accelerated in 2020. As with most internet businesses, Bitcoin is booming off the back of a work from home environment. Curious investors and users have undoubtedly spent time trying to get to grips with this revolutionary financial technology. So the chart on the left here shows us the number of unique wallet addresses which are active each day on the Bitcoin network. While this spiked in December 17, the subsequent growth from 2018 onwards was far more consistent. And we can see that growth stepping up again at the start of 2020, with currently around 750,000 unique wallets there interacting with Bitcoin each day. So in terms of the actual total number of participants, it's a tricky metric to gauge. This is because lots of different providers generate wallet, and we can't have full visibility on the entities that control them. But we've taken blockchain.com wallets here on the right-hand side, who are the single largest provider of wallets in the industry. And you can see that there are over 63 million wallets or users as of 28th of December, a couple of days ago. While this doesn't capture the whole ecosystem, the growth rate is indicative of the adoption that's taking place. And you'll note that while lockdowns may have initially accelerated network usage and were a catalyst for greater usage, we can see that there's been another step up in wallet growth since November this year, which is undoubtedly a response to the surging prices that Charlie walked us through just a minute ago. So what are all these new users doing within the Bitcoin network? This is where it gets really exciting. So there have been a substantial allocation of Bitcoin within the Ethereum ecosystem, which has expanded its use cases and applications. The big story this year has been around decentralized finance, or DeFi, which enables users to game, trade, invest, bet, borrow, lend, all on top of Ethereum's distributed ledger. So while Bitcoin is the most secure digital asset in existence, this security does come with certain limitations by design. But Ethereum, on the other hand, has unlocked Bitcoin security benefits and gold-like qualities. It enables Bitcoin to interact with a wider economy through its smart contract system. So there are currently in excess of 4 billion Bitcoin now on the Ethereum network. And in fact, ByteTree were one of the first to use this in our network demand strategy on token sets. At the time that we launched, I think there were about $8 million worth of Bitcoin on Ethereum. So now 1% of Bitcoin's active supply is being transported around the Ethereum network, known as tokenized Bitcoin. And this is an ERC20 unit issued one-for-one with each Bitcoin that is custodied by a trusted merchant such as BitGo. Very exciting stuff. So on the Bitcoin network itself, layer 2 solutions have also been growing. We've seen the Lightning Network has reached an all-time high in terms of the US dollar capacity, and there are a number of promising applications set to boost accessibility to the network in 2021. In addition to that, investment manager Coinshares have this year launched the world's most secure store of value on the internet's most secure ledger. It's called Digital Gold, or DGLD, and it allows investors to hold gold certificates whose ownership is recorded on the Bitcoin ledger, with the gold itself custodied as you would hope in Swiss vaults and fully redeemable. This is made possible by Bitcoin's natively digital trustless accounting system, a truly remarkable innovation in financial technology. And I believe, this is a major application that we're seeing on Bitcoin, and I think this trend will continue through 2021 and beyond. So one to look out for. Alongside the on-chain demand, which are those points I've just touched on, we also have the off-chain investors, those people that are buying, trading, holding, lending Bitcoin through an ever-growing number of user-focused brokerage platforms and investment applications. Notably, weekly exchange-traded volume has actually hit an all-time high this week, as measured by price data provider CryptoCompare. And let's not forget PayPal and Facebook's projects, which are both kicking off in 2021. So demand for Bitcoin is both on the chain in the applications and off the chain for investors and speculators alike. Okay, so we couldn't talk about Bitcoin as a hard asset without briefly reminding ourselves of its supply schedule. Bitcoin is disinflationary because the rate of inflation is declining over time. As you can see here, around 16.6 million Bitcoin have been minted since the network launched in 2009. The blue line here indicates the total supply that's been minted, with block height along the x-axis and the number of Bitcoin on the y-axis. The orange line here shows the inflation rate, changing each epoch, starting at infinity and dropping to 0 by 2140, when all 21 million Bitcoin will have been issued. Bitcoin's current inflation rate is around 2%, dropping from 4% in May this year. And the next halving, 3.5 years from now, will see the rate drop to 1% per annum, which is half of what gold is on average. So next slide, please, Charlie. Similar to its shiny gold cousin, the mining industry is central to Bitcoin's continued growth. And I am pleased to report that Bitcoin miners are happy and healthy. The chart we're looking at here shows the total miner revenues as a bar chart, with the dark blue line representing the percentage of those revenues that are attributable to fees. The three shaded blocks identify the last three mining epochs, where the block reward went from 25 Bitcoin per new block mined to 12.5 Bitcoin to 6.25 Bitcoin in May this year. Bitcoin miner revenues are made up of a combination of these newly minted Bitcoin as well as the fees. So in dollar terms, miners currently generate around $25 million of revenue per day, which you can see on the right-hand side axis, with a growing proportion of that total revenue now coming from fees since the start of 2020. Each halving period, Bitcoin economists tend to have the same debates about whether total revenues will halve as a result of the number of Bitcoin rewarded to miners dropping in half. But in reality, the continuing demand for space on the Bitcoin ledger, along with a constricting supply, leads to a rise in the price of Bitcoin, offsetting the fall in BTC-denominated mining rewards. So this can be seen by the rising blue line since March this year, where fees have now make up about 10% of total revenues. Incidentally, it's this scarcity for block space on Bitcoin's ledger that makes Bitcoin, the asset, more of a reserve currency than the digital cash it was first conceived as. So on the subject of fees, fees are just one of the metrics that we use at ByteTree to gauge the level of network demand that we see on the network. Our well-recognized network demand jukebox you can see here on the right-hand side shows the 6 metrics we review weekly in our newsletter. If you don't already receive that, I strongly suggest signing up. We measure long and short-term transaction value and fees, network velocity, and miners rolling inventory. When the score of the aggregated indicators is more than 4, we're long Bitcoin, less than 4, and we're in cash. And you can see this applied on the chart on the left-hand side, where it hasn't come out perfectly, but the light brown bar chart lines show the score. And then you can see there in yellow the byte or network demand strategy, and in black is the price of Bitcoin. So interestingly, I mean, you can just about see that we've been bullish since July. So when we've been greater than a 3, and we've been reaching a full bull, or 6 out of 6 in September, November, and now December on the far right on the 28th. Yeah, thank you. Very helpfully indicated there by our cursor. And that was as a result of miners rolling inventory, which had been off for the last few weeks. Just 2 days ago, jumped up and brought us to a 6. And we'll have a quick look at why that's happened. So, okay, now we're looking at on the right-hand side, top right, the chart here shows miner inventories in blue with the Bitcoin price in gold. So miners have been steadily running down their inventory since the start of the year as the price has continued to rise. Our analysis has told us miners sell into price strength. They understand the market bid and they look for a strong price to offload their holdings. So this selling accelerated between October and November, and then slowed down mid-November to sort of late December, which somewhat confused us. But now we realize why. On the 28th of December, a large Bitcoin miner who had been holding back on their inventory for some time, decided to unleash $300 million worth into the market, which was the largest movement in 4 years, so since 2016. And you can see that circled on the right-hand side, that huge change in inventory. So how you can see on the left-hand side, or the bottom left, how this was visible on the ByteTree terminal. Just quickly, because I know a lot of you are avid users, this is on the price chart brackets on chain, where you can see first spend in real time as the blocks come in, and against price, which is the bar chart. And then the line graph on top of that is the exchange traded volume. So what this tells us is, okay, there's been a huge movement of inventory, $300 million worth, but there hasn't been a spike in exchange traded volume. So we expect that this has actually been moved, through the OTC markets. So my last slide, we'll now look at how, so we saw this big move on chain, and with our block by block data, we were able to home in on the exact block where this movement occurred and pinpoint the relevant wallet. So we then used this to investigate the major events that we saw. These sort of real-time analytics feed into our computation engine, which we use for the various strategies that we run. And we can see this inventory movement was made by a miner who had been contributing about 3.5% of Bitcoin's hash rate, steadily accumulating Bitcoin through mining blocks, averaging 5 blocks per day, or around $850,000 daily revenue at current prices. And when the time was right, they decided to move their $300 million. So you can see that red line along the bottom there has been building up and all of a sudden drops to zero. So was it, as I said, OTC market? Was it wrapped into a financial product? Maybe Grayscale, maybe PayPal building an inventory in Bitcoin? That's something we're still investigating. With that, I will now pass over to Charlie Morris to talk about gold versus Bitcoin.
Thank you, James, and thank you all of you for attending, and I hope you've had a very, very good Christmas, if not a quiet one like most of us. Unusually quiet this year. I'm going to bring it back to the old school and remind you that the inspiration behind Bitcoin came from gold. There's a big narrative out there that gold's a pet rock. We keep hearing that. I mean, we heard it in the noughties, and every time gold starts going up, people say that. But surprisingly now, a lot of people in the Bitcoin community are saying it, and they're supposed to be natural allies. After all, the way I see it is that people who get the debasement story are the minority. Because I know that, because if it were the minority, there'd be no confidence in the financial system. So it has to be a minority. And you would think that the people who believe in debasement and see that as an important way to construct your portfolio would work together. And then there's this extraordinary civil war going on between the new school and the old school. I'm unbiased, I'm impartial on both assets. I think they're both fantastic for very different reasons. So we're going to take you through gold, and very quickly, this is my valuation model that I came up with in 2013. And the first chart, what does gold do? Well, it compensates you for past debasement. That's US chain CPI, Consumer Price Index. Lots of confusion on what that means. That's basically what goods cost, not what assets cost, and nor should it take note of asset prices. It's about consumer prices, how much it costs to live. For an average person. And so, that's gone up 10 times over the last 70 years or so. So Bitcoin quite rightly has compensated, gold has quite rightly compensated for that. The second thing that gold does is it rewards you for the present, and if when real interest rates are falling. So we've now had rates coming down to zero, and inflation starting to rise, and so we've seen real interest rates collapse over the last couple of years, and the recent gold rally began in 2018. Notwithstanding the bigger fall, the 5 or 6% fall over the last 20 years, real interest rates have been an important driver of the gold price. But the final piece is the future debasement, and this is the bottom left chart, I believe, unless I've got my left and right got wrong the round way. So this chart here is telling you the future, the what we expect $100 to be worth in 20 years time from now. So look at the spike in 2008. You know, before the credit crisis, people thought the dollar was going to be $100 was going to be worth 60, and then at the height of the crisis, suddenly the money's good, and so actually the debasement was only going to be $10 up to 90. Yeah, and then it all cools off again, and life goes back to normal. And whenever we have one of these spikes, like we had at COVID, when money looks good going into the future, and that's when asset prices start to sell off. And then recently, since the COVID crisis, you know, the future value of a dollar has gone from 80 down to 67. And, you know, if our thesis is right on debasement, that will make a new low. So gold compensates you for that as well. And then finally, bring it all together is my fair value model, and that's shown in black. Now the gold price, can someone stop poking on the screen, please? It's quite off-putting about audio. So the fair value model is in black, and the gold price is shown in gold. Now, from time to time, gold looks cheap against fair value, and at other times it looks expensive. Right now, it's very much in line. So what drives the price of Bitcoin? Well, it isn't real interest rates, and it may well be future debasement, but it's a young asset. We don't really know yet. There are some links to macro, and I'll cover those shortly. But the relationship I discovered back in 2013, I can't believe how well it stood the test of time, frankly. And this is the red and black chart. We look at the transaction value, the amount of money that changes hands over the Bitcoin network in a single week. Yeah, and that's the left-hand axis. The bottom with $100,000 in a single week, and the top $100 billion. And then on the right-hand axis, we've got the network value, and so that's the number of Bitcoins there are, and there are some lost and so on, but we won't go into that right now. Times the price of Bitcoin, and so you end up with a network value. Some people would call it a market cap, but we don't think that's a very good term for a space that is not a company. And notice how the difference between them is basically 10 times. And so in a typical week, the value of the Bitcoin network will be approximately 10 times the amount of money that changes hands. Now we can say it's 10, but actually it's a bit more specific than that. And so if we take the higher number, the black line, and divide it by the lower number, the red line, we end up with the blue chart on the right hand side of the screen. And in the middle of 2014, that the number was very high, and so that was suggesting that the network was highly valued. So the network value was higher than it normally is against the amount of blockchain activity. And at other points, it's been much lower. The thick line in the middle really is some sort of smoothing to try and understand what's changed over time. The main point is it's stabilized, but it has been rising from around 7 to about 11 today. We've used this as a simple valuation metric on the ByteTree.com website, and we started by using the long-term average of 7.7, but then over a year ago recognized that things were starting to change, and so we started to use a trailing moving average, and that's how we calculate the fair value. Slide, please. So, you know, we've had some criticism recently about the fair value lagging the price of Bitcoin. Well, if you do it over 1 week, which we used to publish, but I said take it down, you end up with something very accurate. So the green line shows you using the last week's spend, which at the moment is about $43 billion on the site, and it shows you that's bang in line with what the price is doing right now. Now the blue line shows you what happens if you look over the last 12 weeks, which takes you back to October, to the beginning of October or late September. Unsurprisingly, that number is much lower because we're including traffic in October and November that's materially lower than it was in December. So it shows up as a premium. But if you look over the long term, it's you know, so the bottom line is if the traffic stays where it is and the price stays where it is, they'll come back to an equilibrium, and the valuation will say it's fair value. But the point is, if you look at the 1 week number on the site and then do a mental arithmetic yourself and you say, is the NVT 11 higher or lower, then you have the fair value. The reason we're slightly reluctant to publish it is because it's a very volatile number, and it will just follow the spend, the transaction value in dollar terms. The advantage of the 12-week measure really shows the extremes. So for example, in the middle of the bear market in 2014, it told you that the price was holding up too much. It told you that Bitcoin was dirt cheap in 2015 and 16, which it was. It got the bubble right in 2017, told you to buy in 18, 19, and told you to buy at COVID. And so, when you're using a metric that's deliberately slow, that's more robust, it works for the signal. So please don't worry about the fact that there's a little bit of lag in the time. It takes time to actually measure a network. You can have very good weeks which come and go very quickly. So we stand by our methodology for valuation. I'm gobsmacked how well it's worked over the years, having conceived it 6 years ago. And here it is, still there, still working. But it's not just the network that impacts the Bitcoin price. There are also external considerations. There's many things you could cross-check about this, and I've written much about it in the ByteTree Insights weekly commentary. But I'll highlight two here. One is with momentum assets or sort of risky stocks, the FANGs, the tech stocks, all that kind of stuff. And basically, when they're going up in a positive regime, it's clear, and it's orange when they're under some kind of pressure. And it's no great shock that Bitcoin's most of its appreciation has happened during the white patches, not during the shaded patches. And many of the big drawdowns have occurred in line with tech stocks. And on the other side, a bit of a faster indicator, and I don't recommend you use this for trading, but looking against the VIX. Now, the VIX shows you implied volatility, which is basically, how scary is the stock market in simple terms. And so when it's shaded, that means the stock market's very scary. And that has coincided with many of Bitcoin's largest drawdowns. So, there's no doubt about it. Bitcoin is a risk-on asset. Whereas we know, as proven over many years, that gold is a risk-off asset. Now, gold can fall in March 2020 or in 2008 like it did in dollar terms, but it probably fell materially less than most other risky assets. Whereas we would continue to expect Bitcoin in a shock to probably fall more than most risky assets. And so I think it's very important that when we talk about owning Bitcoin to protect yourself, what we mean is against long-term debasement, not against short-term drawdowns in the cycle. And those can come at any time if the Fed or other monetary authorities decided to withdraw stimulus. It doesn't seem likely, but that is a risk we should all be aware of. Slide, please. I'm going to move on to flows, and we'll start with gold and then see how it impacts Bitcoin. But this is really important, I think, and I've published this chart a couple of times, and I think people must not know what it means because it's so important that no one's really talking about it. But the red line is the premium or discount of gold, the gold price to my fair value model. Yeah, on the right-hand side. So in the summer of this year, we were at basically a 25% premium, and that premium has evaporated. And I noted one of the questions was, has the premium, the gold premium, come down because of people switching to Bitcoin? Well, quite possibly that the shine has come off a little bit. But actually, the red line is just telling you that gold's gone from a premium back towards fair value, no more than that so far. But why has that happened? Well, the black line shows you the investment flows. When it's going up, then investors are going gooey for gold and they want to own lots of it. And when it's coming down, they're not. Now, notice how the flows in black lag the fundamentals. And so the crowd, once again, is behind the curve from the market. And this is typical. And I'd expect that same sort of thing to happen in Bitcoin as well. I would expect the market to lead flows, not the other way around. But nevertheless, the flows have all left the gold market. It's starting to stabilize and gold's fair value. So, to someone like me, that just means gold's low risk from now on because a premium is risky and a discount is very attractive when buying an asset. And what we really want to be able to do is try to understand how to recreate this kind of analysis in Bitcoin. But in truth, we don't have enough flow data from enough sources to get anything like as much credibility as we have from this black line. And this black line is comprised of over 100 gold funds around the world. And so we know exactly how many ounces are coming and going. We're just telling you an awful lot about the market. And the most important point of all, though, is that flows do not change the price. You can't make gold more valuable buying more of it. You can just make it more expensive in the short term. It will always come back to its fair value. And we would say it's exactly the same for Bitcoin. Flows are not why you buy Bitcoin. You buy it because you believe the network is growing. And flows will merely just push the price up too much and down too much. in the short to medium term. Slide, please. And as I say, we're working on improving our Bitcoin flow models, but there's so little to go on right now. But these are the Bitcoin investment funds that have been around for a while. You've got Grayscale at the top. This is their market cap in US dollars or in million US dollars. So 16 billion for the Grayscale Investment Trust, which I think trades at a 20% premium right now. Then in the green line, you've got Coinshares, and there are two products in Sweden in euros and Swedish krona, which I've converted to dollars for the purpose of this chart. And then you've got the newcomers, WisdomTree, who are listed in Germany, 21 shares, used to be called a moon in the sort of blue color. And they're both over $100 billion, as are BTC from Han, but for some reason their data doesn't show up here. And then the newcomer is Van Eck, which has managed to get from nothing to $16 in just a couple of weeks. So well done to them. But sooner or later there'll be more products. We'll be able to aggregate these, and we'll have a much greater understanding of what investment fund flows are. But let's add all those up, and we get to a number of about $20 billion. So not with leaving aside sort of Ruffer and Microstrategy and all that gang, just what normal investor on stock market investments in Bitcoin. Let's call it $20 billion globally. And what happened with gold? Well, gold's obviously been around for 5,000 years as a monetary asset, and 5 billion or trillion years for as an element. But it came to the market, the stock market, as an investable asset in 2004 with the ETF in Australia, also 2003, with the ETF in Australia, followed by the one in London, followed by the one in New York, GLD. Now there are over 100 products, and they got by 2011, they were 17% of the entire US ETF market was represented by gold, which is a huge number. Now the ETF market's grown a lot over the last 8 years, so that's 3 or 4 times bigger, and gold has failed to maintain that share. Once it lost its shine at the peak in 2011, there was the big crash in 13, but nonetheless it sort of settled at 4 or 5%. And I'd imagine that that's a reasonable target of where portfolio allocation will remain over the long term. It might go a bit higher, but I doubt we'll see gold get to more than 10% ever again of overall investment flows. So, Bitcoin's going to follow a similar trajectory as this, in my opinion. The gold invested in ETFs is about $200 billion, and there's no reason why Bitcoin couldn't achieve that. So we've got 20 so far. The target's about 200. That really is the game here. There's a huge amount of coming, and it's going to underpin the price and create an enormous bull market, which won't take 1 year or 2 years. It will take 5, 6, or 7 years. That's the point about the gold market. It took a long time for it to finish the job, and even so, even after this lower allocation to gold, the price, of course, is much higher today than it was in 2000, and not much higher, but it is higher today than it was in 2011. And I suppose my last point really is just to sort of illustrate how hard it is to push up a market as it gets bigger. And I think there's a way of thinking about it, of how many times an asset has doubled and why there's so much excitement about Bitcoin. Well, Bitcoin came to the market at 6 cents, the first recorded price back in 2010. And since then, it went to 12 cents, which took not many days, and not many days to 24 cents and so on. And its 10th halving came at $61 in 2013, and then it hit its 14th doubling. Sorry, not halving, doubling. Its 14th doubling came at $983 in 2013, and then the doubles came in the next bull market. So in 2017, we saw 15, 16, 17, and 18 doubles. Now, since that time, that last double, the 18th at $15,000, happened in 2017, and we're still waiting for the next double to occur at 31,000. Now, with the price at 28,000, it's not far away. But let's remember, this is a $500 billion market we're talking about, and it gets much harder to double $500 billion than it does the very small numbers. So, is there room for that 200 billion of investment? Well, absolutely. because you only have to double once from here, and you've actually made quite a lot of room. So I think it's going to be a great driver, but it's going to be a steady run that's going to take quite a long time to achieve. And if we compare that to gold, going back to 1968 when it came off the standard at $35, it's only doubled 5 times to 70, 140, 281, etc. And the fourth double happened in 1979, and we had to wait to 2011 before we had the fifth double. That's one hell of a long wait. It was 11,000 days, whereas Bitcoin's wait was more like 1,200 days. And the next double's at 2252, which is just around the corner. So it's quite interesting that both gold and Bitcoin are just 10% away from their 19th and their 6th double, respectively. So bit of trivia for you, but I think it's quite an interesting way to think about something. And to put it into perspective, Microsoft has, which IPO'd in 1986, has doubled 11 times. So doubling is hard.
Fantastic. Charlie, thank you very, very much indeed. James, I think I'm going to hand over the host to you now, so you can do another questionnaire.
Okay, brilliant. Yes, thank you, both Charlies. We'll start off by sharing the results from the beginning of the session. So here we go. Do you believe in the stock to flow? 37% yes, 16% no, and nearly half of you haven't heard of stock to flow. Charlie, Morris, how does that make you feel?
Very good.
I thought it might. Do you think gold is a pet rock? 11% yes. We'll have to have words. Probably hardcore Bitcoiners. 89% no. Why do you own Bitcoin? Pretty even across the board. Some of you don't own Bitcoin, mostly to make money, 36%. And finally, Bitcoin is digital gold, digital cash, the reserve asset of the digital economy, or all of the above. We believe it is a bit of everything with different weightings to different uses, but 58% of you agree that all of the above, and 1% a scam. Surely not.
I like that. Come on, who speak up? Why?
If it is a real answer, we'd love to know why. Okay, so I'm now going to share the second poll, which we're going to kick off and have in the background. And we're going to take some of the questions that you've kindly been sending through us throughout the webinar. I'll just note we will be prioritizing questions relating to Bitcoin and gold. And if we have time at the end, we can talk about some Ripple and shitcoins and various other things. So Charlie, do either of you have seen a question you want to take, or should I kick us off?
Well, do you mind if I just talk through these questions very quickly? So question one, do you currently own any of these things, Bitcoin or gold? That's just where you are now. And then if you were really thinking about it carefully, question two, how do you think the optimal position would be? Not necessarily what you'd do, but what do you think intellectually is the right way forward? Just Bitcoin, just gold, some blend, or go and do something else, go and buy government bonds perhaps. And then question three, fun target question, and then finally a gold target question.
Brilliant, good clarification. So I'll run through the questions in the order they've come through, omitting any that I think we've already answered during that time. So can ByteTree, please establish a Byte ETH network demand set, not Bitcoin or gold, but I will say that it's something we're looking into, establishing an ETH network demand set. As you saw, we do see a lot of application across the Ethereum network, even if it isn't quite at the security sort of level that we have with Bitcoin and the supporting infrastructure. Okay, there was a question about, shouldn't a user be considered different to an investor? There may be many that have opened up wallets and now own Bitcoin, but never actually use it as a means of transaction. Is this a fair assessment? Can one measure actual transactions versus new users? I think that's a very astute point that you make. There is very much a difference in those that are using the network on chain, borrowing, lending, interacting with applications. I mentioned gaming and betting and all these different applications. And then those that are just trying to make money, as a number of you pointed out in the poll. So yes, there's definitely a distinction between users and investors. In terms of measuring them, there are lots of different metrics we can look at. Not so many that we publish, but we do look at as part of our analytics. So you can see how often different wallets interact with the chain, the different applications that those wallets interact with, and so on. So yes, there's definitely a distinction to be made, and you can measure it. We have a question. Can you explain how DGLD works? Does the investor receive gold plus Bitcoin return? I'm happy to take that one quickly. So digital gold, you're owning gold. You're paying a small premium. I think it's about 1% in order to have that secured on the Bitcoin network. But you're invested in gold. You're not invested in Bitcoin. The significance of this is that Bitcoin's decentralized distributed ledger basically doesn't have any single entity or third party that is able to amend, what is on the ledger. So if your ownership is written to the Bitcoin ledger, then it's truly sort of undistinguishable from anything else. It's your, sorry, the opposite. It is very much distinguishable from anything else. It is your asset, and you can see it at all time. The idea behind that product was, if there was a giant squeeze on the financial system, and or say a bank run, and people wanted to reclaim their financial assets, be it cash in the bank or gold, how do you know that a third party might not freeze your assets? And so through DGLD, it's really this idea that you can always have access to the wealth that you've put into those assets.
It's very quickly. It's just a gold ETF that's on the blockchain rather than on the stock market, in very simple terms. And we probably ought to disclose that on our board is Danny Masters, who's behind DGLD.
Yes, good disclosure. So, Charlie Morris, this one's for you. We're talking about inventory. We mentioned MRI earlier. When are these miners that have mined and own Bitcoin but not released it into the system? Is there a way to follow the inventory on the side as could really affect price? How do we identify inventory, and how do we know when inventory is moving? It seems like an important thing that we should be tracking, as it may affect price.
Yeah, well, it's on the site, isn't it? On chain. You can see the number of coins mined over a period of time, and the number of coins by the miners being distributed into the network. And the difference between them is inventory. We've also got the long-term inventory number of 1.4 something million, which has dropped, as James pointed out earlier, by about 10,000 coins on Monday. So, it's important to keep an eye. Because that number, one of the fears is that Satoshi's million coins suddenly comes in one go. But that's a number you can track live on the site. So we do think some of these are important. I mean, I think we're never really sure what to publish on ByteTree.com because it's still a free service. It's very much a sort of helpful tool. But we've obviously got a lot more in the background, which we're never sure how much we should give it, how many of our secrets we should be giving away. And so that's what ByteTree Asset Management is a way to express that and make the most of it. Because we're so fed up with being copied, basically. It's really boring. Isn't it, James?
It is indeed. It isn't. Well, flattering to some degree, but also slightly boring. And that's why we set up ByteTree Asset Management, really, is to utilize this data that we're able to extract, for something much larger. So a question on regulation for Mr. Erith, one of your favorite topics. What are your thoughts on the FCA stopping trading in crypto derivatives from January?
Well, I think it's slightly disappointing. It's perhaps not unexpected from our regulator. I think they're still trying to understand crypto and accommodate it, and I'd like to think there's a process of review that they'll look at over time, particularly as institutions and individuals are finding ways and wanting ways to invest in it. It seems it doesn't seem right, really, for us not to be able to choose how to invest our own money. And I think Bitcoin in particular, in fact uniquely amongst the digital assets, has very much become investable for everyone. In terms of its the action sort of threat to Bitcoin itself, I think, as I demonstrated at the start, I think it's immaterial. really for Bitcoin to be regulated out of existence, it requires every regulator on the planet to agree at the same time on the same date, and even then, I don't think it'd be destroyed. So I would like to see our regulators become more accommodating. I suspect it's an upside surprise somewhere over the next 5 years. I really hope it is as well, because I think it's a great asset. Of course, we think it's a great a new asset and a way for people to protect their wealth. And I think it's, you know, they're entitled to have some sort of access to it.
Brilliant. Thank you for that, Charlie. Okay, there's a question here which we've had quite a lot recently, so maybe just a quick note on it. Is there any way of holding Bitcoin in an ISA or SIPP? Now, it seems impossible or very difficult to buy ETPs anymore in the UK. What are our thoughts on that, Charlie?
I don't think you can. I mean, I'm told you can buy Grayscale, but you know, I think you have to be nuts to buy Grayscale. I mean, you should not be paying a premium for Bitcoin. My personal view is that premium will come under pressure at some point in the future, and you know, what's been a great story on the inflows will become an outflow story, particularly if the US approve an ETF, and so everyone can just get the actual Bitcoin price. So, you know, but there are loads of proxies, aren't there? You can buy MicroStrategy shares now. You can buy all sorts of things which are a bit like Bitcoin.
It's a great frustration. We have had many people asking us how, you know, whether they can invest in our fund via a SIPP, and we have asked multiple SIPP providers. All I can say is that for any SIPP provider out there, there's a huge business opportunity, and it's not, you know, it's not an illegal thing. It's just an administrative problem as far as I can work out. So perhaps anyone very sort of entrepreneurial can set up a SIPP provider for alternative assets, including crypto. I think there's a wonderful business, and I think it's something that in time market forces and demand will ensure that we have. But it's desperately frustrating at this point, and all points to sort of, again, pent up demand for the future.
I mean, you can buy in your SIPP. You can legally invest in a sort of dog kennel, can't you, or a nightclub, or all these things, but you can't buy Bitcoin.
Yes, indeed. Another very popular topic, which we'll have to touch on just briefly, is to do with XRP and really how it differs to Bitcoin and Ethereum. I think it's important to touch on, just because many of you may have read that the SEC, Jay Clayton's sort of last move as chairman of the SEC was to call out Ripple or XRP as a security. And it's had a devastating impact on the price of XRP. Now, the interesting thing, or the important thing to note, is that Bitcoin is a decentralized public blockchain, which means that there isn't a single entity that issues new Bitcoin or can sort of create new Bitcoin, whereas Ripple is very much the opposite. Although it is said to be a crypto asset or a cryptocurrency, it operates in a very different way. The guardians of the network are centralized, so it's really the XRP, I can't remember the actual name of the company, but the company that does most of the mining for XRP. So it's very much a different asset. Ethereum, Bitcoin are these public blockchains, and they can't be sort of called out as securities, because they are literally owned by everyone and no one at the same time.
Can I say on XRP, it's quite a funny one, because everyone in the crypto space has always hated it. And everyone in the city who, certainly back in the day, who were sort of skeptical on Bitcoin and blockchain and so on, all liked Ripple, because they felt it was, their way of trading it without actually admitting that they liked Bitcoins. And so it's a funny one. The wrong group liked it, and the right group didn't like it.
And it's not over for them. I mean, it's very much just begun, but one to watch. We wouldn't recommend owning it, is all I will say. Okay, so we have now just passed 5 o'clock. So I think we'll wrap it up there. Just before we do, I will show you the results of that latest poll. Maybe Charlie Morris, you can take us through these ones.
Okay. And I would say, if you've got questions, send us, James, what's an email address they can use at ByteTree?
You can send them to info@bytetree.com. Send us questions. We'll be happy to address them in the newsletter.
info@bytetree.com, and we'll just, interesting questions we'll answer in the weekly, because I think it's a good way to get a discussion going. So, do you currently own Bitcoin? Do you currently own, question mark. Okay, got it. Bitcoin, 11%. Gold and Bitcoin and gold. Fantastic. We've got the right crowd here. People who like both. Neither, 5%. Are you on the wrong call? This is about Bitcoin and gold. I mean, you're very welcome to join us, but that's all we're talking about here: Bitcoin and gold. In number 2, how would you allocate between them next year? Bitcoin only, gold only. Yeah, not many gold only. I'm not surprised by that. I mean, it sort of makes sense. 50-50 wins on the allocation, quite convincingly. But I would think that, 50-50 has been a really good blend, but I'll just give you a clue. The best Sharpe ratio is 70-30. That means the best risk-adjusted return. Obviously, you made more money 50-50 because Bitcoin went through the roof. But our sort of view on this is you make money in Bitcoin and you bank it in gold. That's the sort of strap line, and I think it's true. But it'll be interesting to see going forward. Certainly you'll be glad to have 70-30 in a drawdown. But 50-50, yeah, quite interesting. Right, 3, price target for Bitcoin, 20 to 50. Well, that's what I voted. Or did I do 50 to 100? I can't remember. It's one or the other. 100 plus, we've got 11%, and then we've got 2% of mega bears. And gold, well done the 7% who think 3,000 or above. I think that's a bit punchy. I still have a 7,000 target for 2030. But I think that somewhere between 2 and 3 does seem very likely for this time next year. Below $1,000, my God, there's a maximalist.
Fabulous. Thank you, Charlie. So just a couple of closing remarks. We have got a lot of questions that we will, as Charlie mentioned, follow up with in the newsletter. Do make sure to sign up to that on the website. That will be published every Wednesday at 2 p.m. And the recording of this webinar will also be available through the newsletter and through our various channels. So thank you all for your engagement. Thank you for attending. Have a fantastic new year at home.
Have a very fantastic drink all by yourself in front of the television with 2 other people and the dog or something. And just treasure it, because next year we'll have to have a party and stay up late.
Yeah,
absolutely. Okay.
Happy New Year, everybody.
Happy New Year.